I hate to be the one that's sounding the alarm, but I am sounding the alarm. The banking collapse is here and is actually just getting started, unfortunately. And in this video, I'm going to walk you through a lot of data. I'm going to show you what happened in 2008, 2009, and what sequence of events played out so that you can analyze that and look at what is happening right now to determine potentially what you do with your own wealth. So what we're looking at right now is a regional banking index. You can see that it has just got demolished here recently, all the way down about 54%. And I think it's still got a lot of room to grow because what people don't realize, banks are in $1.7 trillion of unrealized losses. Now, how do they get into unrealized losses? It's because they take the money that you deposit, and in 2020, they made it so that they don't have to keep any of the money that you deposit in the bank. Okay, so 100% of your money that you put in the bank can be invested and lent out to borrowers. So they don't hold, or they don't have to at least hold, any of the money that you deposit in the bank. You're pretty much giving them money and saying, hey, go make investments. And by the way, don't pay me anything. Pay me 0.01% a year and you go do whatever you need to do. And what do? A lot of them bought a ton of treasuries. But treasuries have an inverse relationship to interest rates. So interest rates have been going massively up. We've seen the fastest rate hike in history. And what does that cause? That caused the value of the treasuries to go down. Okay, so since interest rates flew up, all the treasury prices came down 30, 40, 50%. And now the banks are sitting at $1.7 trillion of unrealized losses, which is making a lot of the depositors worried, saying, okay, well, where is my money in this big Ponzi that's happening right now? And then people start to withdraw money. And then this person withdraws money and they talk to that person and that person. And then all of a sudden you get a run on the banks and then they lose the money. They have to liquidate investments at a loss to pay back the depositors. And then what do you know? They don't have 50% of the money because they had 50% in unrealized losses from the investments that they made. So they don't have people's money. They lost it in the market, gambling on treasuries and other debt vehicles. All right. So what has actually played out? Let's go ahead and look at 2006 all the way to through the crash of 2009. So the FOMC paused the rate hikes right around in the summer of 2006. So if we look back here, right, let's actually zoom out a little bit to 06. So this was when they paused rates, right? So you see how this line is flat? They were hiking rates this entire time and paused right here. Okay. Then what did you see happen in the S&P 500? The S&P 500 went up. It rallied all the way to its high of October of 07. Okay. FOMC begins actually cutting rates right here. So yes, it did pause back there, but then what did it do? It started to cut right here in July of 07. Okay, and then this gray box, this big gray box is the actual recession that the US went through. So the FOMC starts to cut rates, okay, and everyone thinks that that's so bullish. Oh, the market's going to go way up, guys, because they're bringing down rates, right, which makes debt easier to attain. It's less expensive, and that should make people borrow more money, spend more money, and it should increase the velocity of money. Maybe it increases inflation a little bit, but the overall economy should be better, right? No. What happens is when they hike rates for this long, well, it makes it very difficult for things to play out right away. But as they bring up rates, the ripple effect then starts to play out, usually after they pause and then drop rates. If we look at 2000, guys, what happened? Well, they came up to the high, they paused rates, they started to drop rates, and then what happened? The tech bust of 2000 collapsed. Okay, same thing in 08. They hiked rates, paused, we saw a little bit of a rally, and then we saw a huge drop in rates and a massive drop in the S&P 500, over 50%. Okay, then we see right here, Bank of America buys Countrywide. Then we see JP Morgan buys Bear Stearns because Bear Stearns goes under. Then we see Bank of America buys Merrill Lynch. Also, Lehman Brothers goes bankrupt. And as one starts to fall after another, everyone starts to get really worried about the stability of not only the, US dollar, the actual banking system, but also the stock market and bond market. And what happened? We saw a massive drop after that. So the total drawdown from here to the bottom was 57% after the actual, freak out, which is really like the big panic moment, which is when Merrill Lynch and then, Lehman went under, was, that was another 48% just from there to there. So and then you saw Wells Fargo also buy another bank called Wachovia. And now what is happening? Let's actually look at our timeline. Well, we just talked about how, they have not actually paused rates. They continue to hike, even though we are seeing massive banks go bankrupt. I'm going to have to show you. It's pretty crazy the size of the banks that are going down. It is not a good sign. And I don't want to be the fear mongerer, but this is reality. Okay. So we saw the big, sell off, actually the biggest drawdown in US dollar terms that markets have ever seen, because of bonds, commodities, crypto stocks, everything went down as they started to hike rates. Now we've seen a little bit of a rally, but we saw SVB, Silvergate, and Signature Bank go insolvent right here. Then we see UBS buys Credit Suisse right here. Then we see JP Morgan buys First Republic. And these are not small acquisitions. These are really big acquisitions, really big banks going under. I mean, SVB, Silvergate, and Signature all went under in like the same week. It was crazy. Then we saw Credit Suisse, massive bank, Republic, one of the biggest banks that we've seen going bankrupt ever. And actually, to put this into context, this is how many banks went bankrupt in 2008, 2009. So in the middle of this big Christmas tree right here, those are all the different banks with how big their deposits were. So you can see Washington Mutual Bank was the biggest bank that ever went under at $307 billion dollars in deposits. Now we're looking to the right. We've got Signature Bank, we've got Silicon Valley Bank, we've got First Republic Bank at 110 billion, 209 billion, and 229 billion. Look how big those bubbles are relative to these other bubbles. And let's actually go ahead and look at the list of the failed banks. If we were to look at it in a sequential order here, 2009, 140 banks went under. 2010, 157 banks went under. 2011, 92 banks went under. So once the dominoes start to fall and the avalanche starts from the top of the mountain, you start to see some big things happening. And then what happens? It slides and it picks up momentum, and more go under and under. And the fact that we have not even paused rates yet, okay, and this is already happening, and the Fed is still hiking, and they're saying they're probably going to hike another time, and then they're going to hold rates really high for an extended amount of time until inflation reaches the target of 2%. Who knows how long that's going to take? Right now, we're not even close. Like, it's a big drop that we got to see in inflation for that to happen. So this is a bad sign that you see these bubbles really big right here, and you're seeing massive banks go under before we have even paused and even dropped rates. Because again, the ripple effect of the fastest interest rate hikes in the history of the world is going to be massive. It's going to be bigger than people think. So I also want to show you a few other charts here, actually really just this one, and then I want to bring in this X factor too, and I'll leave you with my rant on kind of what I am doing. So this is the 10-year Treasury minus the three-month Treasury. This has a 100% win rate. Every single time this has gone below zero, guys. What has happened? A recession has followed. So you'll see the gray line started, it was below zero back then. It was below zero right here, recession. Below zero, tech bubble and recession, below zero, 2008, below zero briefly, and then what happened? The COVID, pandemic. And then what's happening right now, guys? Is this below zero? I don't know. It's kind of getting close. Oh no, it is way below zero. Okay, we are seeing dramatic things play out right now that I don't think really anyone has seen. And it's not just because I'm not like 90 years old and I've seen everything. I just listen to really intelligent people such as Stanley Druckenmiller, which has averaged over 30% for about 30 years. And he is saying it's one of the most confusing times, and he is betting big on a hard landing. What does a hard landing mean? That means that you see a really big sell-off in the stock market. So last thing I want to bring in is the X factor. To bring in more fear, which is the last thing that we really need, is this whole war that's going on overseas. This just happened the other day where there was a drone that struck a Russian building and a Russian diplomatic building. It was a big deal. It's called the Kremlin Senate building. And this drone came and hit the flag. It wasn't like a massive explosion. It did explode. It didn't even destroy the flag. Honestly, it was kind of sad. But regardless, now we're starting to see attacks on the Russian soil. Meanwhile, this has been going on in Ukraine. Russia is now accusing the U.S. and Ukraine for this drone attack. And obviously, Russia and China have been teaming up with a list of other countries trying to dethrone the U.S. dollar and the U.S., take over Ukraine, and not to mention China is also trying to take over Taiwan and has warships outside of Taiwan circling right now. So there's very likely to be, and I'm not some war expert or some political expert, but it doesn't seem like things are moving in the direction of these things not getting worse. And what happens when things start to escalate and people get very fearful of a potential war? Just go look at some of my other videos. I even went over, 2001, the terrorist attacks. You'll see the markets freak out. The markets sell off very, very quickly when there is a glimpse of a big war that's potentially happening, or a massive terrorist attack. And this is just further adding to the equation of a potential another 2008 type drop, if not even worse. Because I also think that people need to zoom out, guys. I mean, let's get back to reality a little bit. This was all of 2008. Look at the run that we just had. Massive move in equities. Okay, huge. So when we see this big of a move, and now we're kind of seeing a little bit of a dead cat bounce, in my opinion. And then all these things start to play out, all these banks going bankrupt, the wars, blah, blah, blah. I think things are about to get worse. And I was projecting a little bit of a bigger relief rally. And who knows, maybe we will, because maybe we get things hold off, but it doesn't look at all these red arrows within the past few weeks. I don't think it's going to get much better, but let's say, hey, if we do pause rates in the summer, maybe we see a little bit of a relief rally, but I really do believe by the end of this year, we're going to see a big sell-off in the stock market. I think bonds are going to keep trending lower because no one really trusts that. And also rates are still even going up right now. And then also inflation is high. Inflation is exceeding the rate of return that a lot of times you would even get from investing in treasuries or fixed income, because that's why you buy fixed income, is for the income. And right now, inflation is higher than the income rate. So it doesn't really make a lot of sense to be buying bonds right now. And it doesn't make a lot of sense to be buying equities with everything that I just mentioned. So what actually makes sense? Well, I actually shot a video about commodities and how I think precious metals is the spot to be right now, because what happens when there is distrust in fiat currency, distrust in financial sectors, in the banks, and then more fear in the markets as well. You see people flock to precious metals for safety, specifically gold and silver. So I'm pretty heavily, the only equities that I'm holding right now are gold mining stocks. I'm holding commodities as well, and then I'm holding a lot of crypto. And I will tell you that every time the banks have been going under, Bitcoin has been rallying. And this is the time that Bitcoin and crypto would potentially shine, but especially Bitcoin, is because this is the biggest use case for Bitcoin, is that store of that value asset where you can actually hold the storage for your own asset. You have custody of your own asset, which you do not have when you're deposited with another financial institution or you have money in the bank. That is not your money. It's an IOU. Okay. When you hold Bitcoin on a cold wallet, you are holding your own asset. It reduces that counterparty risk that we all have when we hold money and assets with other institutions. And what is happening right now? People aren't wanting to have this counterparty risk. And people are starting to understand the utility and use case for Bitcoin. And there's a lot of other things that I could go into, but that's for another video. But I will say that we are starting to see the market react positively to Bitcoin because it is reflecting, in my opinion, the use case that Bitcoin is a hedge against banks and a hedge against fiat currencies. And it's pretty much guaranteed. Because what's going to happen, guys, if this rolls over? What happens? Guess what they do? And by the way, the FDIC is already out of money. But what are they going to do? They're going to keep backstopping it with more and more money. Where does that money come from? It comes from them printing more money. They keep debasing the currency. And if we see a massive sell-off in the stock market and we see another big recession, guess what's going to happen? More helicopter money, which means that they're going to debase your currency, the thing that you work very hard for, even more. It's a silent tax that erodes your own wealth. And how can you protect your wealth? You invest your wealth and the value that you worked hard for into things that don't have infinite supply, have fixed supply, or at least have a logical supply where you could actually project out the growth of that supply. You've got to take that currency that has an infinite supply and start putting it into scarce assets. That's why some of the smartest people in the world, they like precious metals, they like Bitcoin, they like real estate, because at least they understand the supply and demand metrics there. Okay. So anyways, let me know what you're doing below. I'm sure maybe you've got your own thesis. Maybe you think we're going to all-time highs and we're just going to ride the wave to new heights. But I would love to hear your opinion on what you think is happening right now with the banking debacle and also the craziness in the markets, because meme coins are flying as well. So maybe those are a hedge against the US banking system. Let me know in the comment section below. Thanks so much. I'll see you here in this next video.